Great. Look, by way of background, AIMS APAC REIT, or AA REIT for short, we are an industrial REIT. We've been listed on the SGX since 2007. Our current total assets under management is about 2.4 billion, with a market cap just under 1 billion. Our most recent closing price of $1.41 is about 2% above NAV, and currently delivers a 6.7% dividend yield. And over the past 10 years, AIMS has delivered a total return of 112%. Lastly, AA REIT is sponsored by AIMS Financial Group. AIMS Financial Group is a financial services company headquartered in Sydney, Australia. Next slide. As you can see on this chart, our AUM has grown by about 160% from 854 million back in FY 2011 to 2.2 billion today from a property value perspective. This reflects a 7% annual compounding growth rate over that period. Importantly, as you can see on the lower sort of table, we have grown and created significant value through a combination of redevelopments, developments, asset enhancements of older assets into modern facilities, and also through the acquisition of third-party assets. Our inclusion in several indices, the MSCI, FTSE Russell, and APRA NAREIT, over 2020 and 2021, recognizes our milestone and our current scale to date. Slide. Look, our portfolio comprises, as you can see, really a good blend of industrial properties. This does range from logistics and warehouse, business parks, high tech, light and general industrial. Now, logistics are typically occupied by third-party operators such as DHL and Schenker. These are global businesses. Our business parks are characterized by decentralized office locations, which are typically suitable for corporates who don't need to be in a CBD. And typically you see them in the tech sector, pharmaceutical sector, as well as tech, IT companies. High tech in this instance relates mostly to high value added industries that have quite a number of either laboratory space or R&D activities, and are typically suited for sectors in the life science and pharmaceutical industries. Light industrial, these typically comprise of office-like units with some ancillary production facilities. Under our classification, this also includes data centers. And of course, general industrial includes all other industrial properties, which typically are catering for manufacturing and production facilities. So across Singapore, we have 26 properties, really spread throughout the southwest, west, north, and east clusters. As you can see on this map, most of our properties are located within established industrial precincts and are located fairly close to the key expressways in Singapore. In Australia, we have 3 properties, 2 under business parks classification and 1 under light industrial. Of the 2 business park assets, they are located in Norwest Business Park in Sydney, and the other property is located at Macquarie Park, also in Sydney. Our third property, Board Riders, is located up at the Gold Coast, and it is catering towards surf and lifestyle brands such as Quicksilver and Roxy. Next slide. We wanted to include this slide just to give viewers, I guess, a bit more insight in our most recent acquisition. We completed this acquisition back in November. This is the Woolworths headquarters. For most of you that have traveled there, it is Australia's largest supermarket chain. Now, this was a significant acquisition for us in terms of its scale, as well as the quality of its assets, of the asset and tenant. The acquisition, when we looked at it, really sort of followed what we did back in 2014 when we acquired Optus Centre. When we acquired Optus Centre in 2014, that was about 370 million. Today, that value is close to double over the past 7 years. And we managed over that period to undergo a CapEx retention strategy where we work with the tenant, Optus in that instance, and as a result, renewed the lease for a further 10 years. Woolworths follows a very similar characteristics. We like the investment for several reasons. Firstly, it does provide us access into a new business park and data center precinct. This entire precinct we have found to be linked to 3 data centers, one with the Reserve Bank of Australia, one with Commonwealth Bank of Australia, and also one linked to IBM. Aside from data centers, there are also quite a number of corporates in the pharmaceutical, medical, and technology industries. Secondly, the property is leased to Woolworths, and as mentioned, it is a top 10 ASX listed company. So it's got an excellent credit and ultimately underpins the portfolio cash flow over the next 10 years. Thirdly, we like the fact that the property has been very well maintained. I think since the property was built in 2005, they have spent a combination of up to $50 million on CapEx, on the office fit outs, on the foyers, on the amenities, on all the M&E equipment. There were also new solar panels installed across the rooftop of all 3 buildings just over the last 2 years. So there's very little major CapEx that has to be spent. It is a very well maintained property. And fourthly, the site is about 9 hectares, 90,000 square meters. And the property is currently built to about 44,000 square meters. If you look at the current planning rules, this site can cater up to about 180,000 square meters. So over the long term, we think that this site not only gives you your stable income distribution over the next 10 years, but potentially gives us an opportunity to redevelop the site and add additional GFA to the property. So you have that optionality on a long-term capital upside. Next slide. We've decided to include our last quarterly highlights. Our 4Q results will be coming out towards the end of April. But just in terms of our December results, as you can see, given the quality of our portfolio, as well as the quality of our tenant roster, we have delivered fairly consistent and resilient results. Our Q3 MPI and DPU results reflected about a 14 to 15% year-on-year growth. On a portfolio metrics in the middle column, you can see that our portfolio occupancy currently is about 97%, and we have a WALE of about 4.85 years. And so for those of you that may not be familiar, the WALE is essentially the weighted average lease to expiry. So from a REIT perspective, that is quite a long period, and that's really underpinned by quite a number of master tenants, including Woolworths headquarters. We also reported fairly conservative capital management metrics. Our current leverage is about 37%. And as you can see, our current interest cover is about 5.3 times. We've also have over 237 million worth of cash and uncommitted lines available. So we do have quite a strong sort of funding base for future either capital works and or acquisitions. Next page. Based on the last closing price of $1.41, as I mentioned, our dividend yield is about 6.7%. It's a very healthy spread over the current 10-year government bond yields. And if we look historically since 2012, AA REIT's performance has outperformed the FTSE STI as well as the FTSE REIT indices. And as highlighted earlier, our Q3 revenue MPI as well as our DPU was high by about 14 to 15% on a year-on-year basis. And similarly, our 9-month year-to-date results showed about a 13% growth on revenue and a 70% growth at net property income and distribution. Slide. Also, as earlier highlighted, our current balance sheet is quite conservative, um, with total assets about 2.36 billion versus our current total borrowings of about 837 million dollars. Next slide. As you can see, since 2011, we have had relatively stable MPI growth over the past 10 years, with MPI CAGR coming close to about 5.1%. Next slide. This slide shows a summary of our portfolio stats on a quarter-on-quarter basis. And as mentioned, we did acquire Woolworths in the last quarter. So that rose our stats across the board from our property value, rising from 1.75 billion to just over 2.2 billion. And as well as our total NLA, total net lettable area. Our portfolio occupancy also was reasonably flat, but our portfolio WALE and our overall portfolio ground lease increased to about 4.85 years and 56 years, respectively, following that acquisition. And I can say that the current WALE from both the portfolio as well as the ground lease is one of the highest amongst our industrial REIT peers. This slide provides I guess a good reflection of our portfolio, and just to provide some diversity. Australia now accounts for about 38% of the portfolio. And if you look in terms of the asset segments, around 40% is in the logistics and warehouse segment. You got 30% in business parks. And I think the rest are reasonably split between your general industrial, light industrial, and high-tech space. So some good diversity there. We are also reasonably even split between our master lease structures and our multi-tenanted leases. Our master leases are mostly comprised of our 3 Australian properties. As I mentioned, they are leased to three separate corporates as a master tenant: Optus, Woolworths, and Boardriders, as well as a handful of properties in Singapore. We think that complements very nicely with the multi-tenanted properties. Multi-tenanted properties allows you to basically capture your rental reversions, whereas your master lease gives you a long sort of stable cash flow over a long period. It is beneficial to have both, and I think recently we have seen that there's been some very healthy rent reversions, particularly in our logistics and warehouse assets. And so our multi-tenanted portfolios typically will have about 2 to 3 year lease tenants. And below, this provides a copy of our current lease expiry profile. As you can see, they are fairly well staggered. In any 1 year, we typically have about 15 to 20% of leases coming due to expire. And so we've always managed to get ahead of most of these expiries, and generate a very stable performance and keep our occupancy high compared to market. Next slide. And as mentioned, our current sort of ground lease tenor is amongst one of the highest amongst our industrial peers at 45 years by valuation. Next slide. So we currently see three key trends, and we believe our portfolio is well positioned to capitalize on these trends. Firstly, the expansion of the manufacturing and production sectors is closely in line with the growth of Singapore's economy. So as long as Singapore's economy continues to grow, we expect these sectors to also grow in tandem. Secondly, the e-commerce boom during COVID has really accelerated the digital trend, as well as omni-channel distribution. And so what we're seeing is good sustained demand for high quality warehouse space. There's certainly been no shortages to date. Even on some of our properties, we do get anywhere from 3 to 6 offers at one time. So we think that this sector is going to, the strength of this subsector is going to continue. And thirdly, we are also seeing many companies adopt a hub and spoke approach and seeking good quality office premises in business parks and suburban locations, which are closer to home. For example, for Woolworths, we understand that even though this is the headquarters, quite a number of their employees would go to headquarters most throughout the week, but they also have other satellite offices around the country. So that's a pretty common trait, particularly in markets like Australia. Slide. We have for what we call a four-prong strategic approach to our business. Firstly, we are committed to growth through investments and developments. Now this also includes some of the built-to-suit projects that we've done in the past for our customers. The second one is sustained portfolio performance. So what we mean by that is really sort of active asset management, getting ahead of any lease expiries, making sure that we are negotiating and achieving our rent reversions on a longer tenor. This also involves looking at asset enhancements. So over the past 10 years, we've undergone at least one major development or redevelopment or asset enhancements once every 1.5 years. I think during COVID, that activity stopped, but we are looking and monitoring the market very closely and seeing whether we can start to activate some of these enhancements as well as potential redevelopment opportunities, depending on how global markets are and also the impact of material costs and labor costs. Thirdly, we continue to adopt a very prudent approach to how we manage our capital management. Our target sort of gearing, over the long term will be ranging between 30 to 40%. Now, I think lastly, capital and business partnerships. Now, this was a recent inclusion. We see this as a very important leg of growth through either working with new capital partners on larger projects. That also allows us to diversify our risk and work with on different projects rather than having our investment on one project. Also importantly, this from a business partnership perspective, we have been engaging with some of our existing customers and tenants that are looking for expansion space. So as part of that process, we will help them engage with JTC on any new land allocation, talk on new designs. And this could be food operators, this could be logistics operators, this could also be data center operators. So again, the partnerships strategic angle is going to be important for our growth going forward. Next slide. We thought we'd just include 3 case studies just to give viewers just a sample of the things that we do. For case 1, we redeveloped 3 Tuas Avenue 2. Now, in this example, we did increase the total floor area by 52% to about 270,000 square feet. It was an older property at the time, and we effectively tore down and rebuilt the property. So I guess this is an example of how we look to modernize our portfolio on an ongoing basis. We do have almost 500,000 square feet of untapped plot ratio. So I think this is going to be a big part of our organic growth engine in the future. Number 2, asset enhancements. Now, again, this is equally important. Not every asset would qualify for redevelopment because, for example, that they have been fully maximized in terms of their plot ratio. And from a redevelopment risk return metrics, it just doesn't make sense. But there are other properties that we think we can do some sort of light touches, upgrades to lobby areas, to common areas, upgrades to new M&E equipment to make the building more efficient from an energy consumption basis. And so number 2 was an example where we worked with one of our major life science customers. When they came into the building, they were leasing about 60% of the property. And we continued to work with them because they were looking for more space. But as they were looking for more space, we also upgraded quite a number of the common areas. And as a result, that tenant has slowly sort of taken up more space at the building and also entered into long leases for up to 10 years. So it's a win-win for both ourselves and the customer. The third example was also an acquisition that we completed, right in the midst of COVID. Now we did have a lot of stakeholders at the time asking why we were acquiring this asset right at that time. Having walked through numerous warehouse properties, we saw that this building was very well built, and it was currently leased to KWE, a pretty major logistics operator in Japan. And so we will look at acquiring assets at all times of the cycle if we think that the asset quality is strong, and the credit quality is also resilient. So I think, depending where we are in the cycle, we will still look at acquisitions, but strategically. Next slide. Now ESG is obviously an important topic. We have over the years been committed, on everything from our sustainable features to how we report and our governance, and we have been also recognised for some of our corporate governance and social responsibilities. We are also spending quite a bit of time looking at ways to improve our building energy consumptions and also our carbon emissions. So this is something that we look to share with investors in due course once we have the initiative finalized. Great. On the macro outfront, the IMF has retained its GDP growth rate of about 4.9%. Now, this generally aligns with Singapore's growth outlook. Singapore has a growth outlook of between 3 to 5% in 2022. And again, we think that the industrial sector is correlated to Singapore's growth. Similarly, Australia's economy and local property market has started to benefit. I think a little bit earlier than Singapore, due to its opening of its borders, as well as the recovery of the economy as well. So despite the ongoing current Russia-Ukraine conflict, we are comfortable that our portfolio it is resilient. It's proven itself over the COVID period, due mostly to the quality assets that we have, as well as the strong credit rated customers that are currently occupying our properties. Next slide. So to recap, our portfolio, it's a well-diversified portfolio. It's continued to generate stable and resilient returns quarter on quarter. Again, this is due to strong portfolio metrics and the type of assets that we've been acquiring. And just to conclude, we are committed to delivering investors with distribution growth over the long term, and also continuously looking at ways to find organic growth through redevelopments, as well as asset enhancements. And I think with that really concludes the corporate presentation.